Welcome to CoreLogic's housing market update for September 2021, brought to you by onthehouse.com.au. Despite many parts of the country remaining in some level of lockdown, the housing boom continued to roll on, with national home values rising another 1.5% last month. The rate of growth remains strong across most areas of the country, but we are seeing mounting evidence the growth trend is losing some momentum. The 1.5% rise in August was actually the softest monthly outcome since January this year. The slowing rate of growth probably has more to do with worsening housing affordability constraints than ongoing lockdowns. Housing prices have been rising almost 11 times faster than wages growth over the past year, creating a more significant barrier to entry for those who don't yet own a home. Lockdowns are having a clear impact on consumer sentiment. However, to date, restrictions have resulted in falling advertised listing numbers and, to a lesser extent, fewer home sales, with less impact on price growth momentum. It's likely the ongoing shortage of properties available to purchase is central to the upwards pressure on housing values. The latest update takes Australian housing values 15.8% higher over the first 8 months of the year and 18.4% above levels a year ago. In dollar terms, the annual increase in national dwelling values equates to approximately $103,400, or about $1,990 per week. In comparison, Australian wages are rising at the average annual rate of 1.7%. This is the fastest annual pace of growth in housing values since the year ending July 1989. As a quick retrospective, in the late 1980s, the annual pace of national home value appreciation was as high as 31%, so the market isn't quite in unprecedented territory. The annual growth rate at the moment is trending higher. In fact, it's 3.6 times higher than the 30-year average rate of annual growth. Capital city houses are continuing to record a stronger growth rate relative to units. However, the performance gap does appear to be narrowing. Throughout the first quarter of the year, capital city house values were rising at approximately 1.1 percentage points faster than units each month. By August, the average performance gap had reduced to 0.7 percentage points. The convergence of growth in house values and unit values could be another demonstration of affordability becoming more challenging, and it's most noticeable in Australia's most expensive city, Sydney, where the monthly growth rate for houses was 2 percentage points higher than units in March. That gap has now reduced to 0.6 percentage points in August. Based on median values, Sydney units cost almost $470,000 less than a house. Turning our focus to supply and demand, both advertised supply and housing demand have been negatively impacted over recent months. In early May, newly advertised properties were tracking almost 20% above the 5-year average. However, due to both lockdowns and seasonal factors, the number of new listings through August dropped to almost 6% below the 5-year average, and total active listings were closer to 30% below average. The estimated number of home sales has also been impacted, dropping by 9% nationally over the 3 months ending August when compared to the previous 3-month period. Despite the fall in sales, housing market activity remains at well above average levels. Although there has recently been a trend towards fewer buyers, the past 3 months has seen the number of home sales remain 30% above the 5-year average, at a time when active listings are 29% below average. Clearly, there is still a disconnect between advertised supply and housing demand, even in the cities where lockdown restrictions are active, which is keeping upwards pressure on housing prices despite the challenges faced by both buyers and sellers located in cities with mobility and social distancing restrictions. Strong selling conditions can also be seen in auction clearance rates and private treaty measures. Auction clearance rates have trended lower, especially in Melbourne, where a large proportion of auctions have been withdrawn from the market. However, where properties have proceeded to auction, the large majority are recording a successful result, albeit with a large proportion selling prior to the auction rather than under the hammer. Similarly, the median number of days it takes to sell a property is showing a mild upwards trend. However, most cities, including those navigating extended lockdowns, are continuing to see homes selling in 30 to 35 days or less. At the same time, vendor discounting rates remain at record lows, implying vendors aren't budging much on their initial pricing expectations. The most visible impact on Sydney's housing market as it navigates the extended lockdown is the decline in advertised stock levels. New listings added to the Sydney market have fallen from being 36% above average in early May to almost 13% below average by the end of August. Total active listings were 22% lower than average at the end of August. The decline in available inventory is another factor supporting the upwards pressure on housing prices, where through August we saw housing values rise a further 1.8%, taking the market 20.9% higher over the past 12 months. In dollar value terms, Sydney dwelling values have risen by approximately $180,000 over the past 12 months, or about $3,460 per week. With housing becoming less affordable, the rate of growth across the Sydney market has been progressively easing since March, when housing values rose at the monthly rate of 3.7%. Australia's housing market appears to be navigating the uncertainties associated with the Delta outbreaks, much the same as we've seen through previous lockdowns. Supported by low advertised stock levels relative to buyer demand, housing values are continuing to rise, albeit at a slower pace than earlier this year. Inventory levels have fallen sharply across the cities where lockdowns persist, but more broadly, advertised stock levels remain low across the country as demand continues to outweigh supply, resulting in a rapid rate of absorption of new listings. The volume of home sales has trended lower, mostly due to restrictions in Sydney and Melbourne, where the number of sales is estimated to have fallen by 19% and 34% respectively when compared with the prior 3-month period. Rules associated with physical property inspections are stricter in Melbourne, which probably helps to explain the larger reduction in sales activity. With spring arriving, we would normally start to see new listing numbers ramping up. And there is some evidence of this happening in Brisbane, in Adelaide and Perth and Hobart. However, the same cannot be said for the cities where lockdown restrictions remain in place. The trend in new listings remains weak in Sydney, Melbourne and Canberra. Housing market activity bounced back quite quickly following previous spot lockdowns and after Melbourne's extended lockdown late last year, and we are expecting a similar turn of events once restrictions are eventually lifted. There is likely to be an element of pent-up supply that's unleashed when restrictions ease, which should see inventory levels rise. Arguably, there's greater uncertainty about whether demand will rise at the same level following lockdowns. Affordability constraints are likely to progressively dampen housing market activity, and further down the track, there's also the potential for credit tightening to have a negative impact on demand. A lift in advertised supply, in the absence of more buyers, could be another factor that weighs on price growth later this year. The trend through spring will be highly dependent on what happens with COVID and associated restrictions. Any signs of an easing in restrictions should see a rise in advertised stock levels as the delayed spring listing season gets underway. However, a worsening or broadening of the outbreak into other states will of course have some downside impacts. As always, we'll be monitoring the intra-month trends via the research pages at CoreLogic.com.au.